As Treasury yields pull back from multi-year highs following weaker than expected jobs data, uncertainty still remains over what the Fed's next move might be in its fight against inflation. Our next guest says the bond market could be having a panic attack. Komal Sri-Kumar is the president of Sri-Kumar Global Strategies. He joins us to explain the panic attack. Is it here? Is this the panic attack, or is there a lot more panic to come?
Andrew, this is clearly a panic attack. Whether there is more to come or not, it's not clear. And the reason is, it all happened suddenly. There was no new development. The fiscal deficit has always been high. On top of that, we have had pressure from inflation. And so it is not as if the bond market has some new information. But the panic attack came, I believe, because they essentially found that the Fed was not responding to the increase in interest rates. There was no statement being made. And suddenly they piled upon each other to sell the bonds, and it pushed the yield up. But that brings its own end, Andrew, after a period of time, because this is going to cause a shock, like I've been talking on your program, a credit event. And my particular target is the banking sector. You're going to see more deposits flow out of regional banks. For instance, today on 6-month Treasury bills, you can get 5.6%. So there is no reason why you should be keeping your money in a regional bank at half that level. So that's going to happen. The second is you're going to have the banks cut back on their lending as a result of all of the regulatory checks. So I think if you ask me what is the absolute peak right now, Andrew, I would probably say 5%, but I doubt we'll even get there.
But what do you think, if something is to break, what is it first? The regional banks?
I have a few favorite candidates. Regional banks is the top candidate that I have, a repeat of the March crisis, but much worse than it was in March. Second, it spreads to some of the larger banks. You see that the larger bank share prices have been under pressure. They are also suffering from an outflow of funds. Another culprit that I have in mind is what happens with the pension funds. Remember the UK pension funds in September of last year, when interest rates shot up on the bond yields, they all had massive losses. So if that happens, you're going to have public pension funds in the United States lose money. They have to go to the treasurers of different states asking for higher taxes or reducing the benefits of employees. That is not acceptable. That, again, is a second way of doing it. Third shock, the commercial real estate crisis, which we have been talking about, is likely to get even worse with the fact that the bond yields are much higher, and along with it, the various interest rates are going to rise as well.
Okay, you've just told us everything bad that could happen. Is there a scenario in which you think what's just taken place even over the last 48 hours or the last week somehow reverses itself in short order? You asked for good news, Andrew. I can give you good news, but that is not a reversal by itself. The good news comes because anything like a credit event will cause the Federal Reserve to shift, stop increasing interest rates, and perhaps switch over to quantitative easing. They switched to quantitative easing in March when the banking crisis came. And remember, we talk about the 10-year yield being as high as it was in 2007, and we know what happened that year. That caused the great financial crisis to begin. So all of those will cause. You just told me you were going to tell me good news, Sri. What's the good news in that?
That is the good news. You have a rally in bonds and you have a rally in equities as the Fed comes to the rescue and inflation comes down as well. But then something has to break in the system before you get the good news.
But the good news that you're talking about is something that's going to push the market down. Like, to this point, every time yields go up, the stock market drops. Equities drop because there are concerns about higher interest rates. Under the scenario that you're describing, interest rates would come down, but it wouldn't be for a reason that the market would probably like. It would probably put pressure on stocks at the same time. So that's your definition of the good news?
It would put pressure on stocks in the short term, Becky, but if you have the interest rates come down,
And if the markets realize that Fed is on their side now rather than fighting inflation, that is going to help equities. Think about March of 2009. We had, again, interest rates come down from December 2008 for the first 2 or 3 months of 2009. March 2009, March 9th, was the bottom for the S&P 500 index. And thereafter, we had a rally taking place in equities. So that is what a credit event can do for you.
Sri, there's a top story on the Wall Street Journal right now online. Rising interest rates mean deficits finally matter. That's an even bigger issue in terms of the government and the sort of the larger picture. How do you think that plays into it and the potential government shutdown? Should we even think about that, or is this something you think that's much more specific to the banking system and the like?
We will keep talking about it for a while, Andrew, but right now, yes, that is important. The fiscal deficit is large. That is partly what prompted the interest rates to go up. And interest rates going up in turn will cause the fiscal deficit to worsen because the government's debt service is going to increase. So what I think it is going to do, and if you have a shutdown of the government on November 17th, the next deadline date, and if there is a total gridlock in government after that, that might help bring some of the deficit down, and that may be a positive as far as interest rates are concerned. But it doesn't happen by itself. Second thing that is helping in terms of the deficit front is that you do not have a credible alternative to holding U.S. treasuries on a global scale. The euros are not yet big enough. The Chinese renminbi yuan denominated bonds are nowhere in the picture. So if you don't like U.S. treasuries, there is not very much else where you can go.